Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review. I'm recording this late Friday morning, as usual, October 27th. So, unfortunately, there's not really that much new to say when it comes to the market, at least in terms of there's been a lot of action, but not much new to say, right? The intermediate term trend of just about every index, the vast majority of stocks and sectors is down. The intermediate term trend of interest rates remains up. Obviously, there's a lot of headline risk out there. So, the big picture is just the same. You want to stay close to shore, stay cautious, however you want to phrase it. Plenty of cash, whatever that means to you. If you want to do a little nibbling here and there, that's fine. But just staying safe, let the selling play itself out, which it will, okay? And we'll go on from there. Right now, the best pieces of evidence, so to speak, for the market are really secondary pieces. And they are fairly legitimate. To me, the news is terrible. It's very obvious, I think, why the market is soft, what the risks are in the world. The Middle East obviously is kind of like the powder keg, but interest rates everybody's talking about. As soon as interest rates go up to a certain level and mortgage rates hit 8%, it's all over the headlines. Everything's very obvious, as opposed to even 3 months ago when the market recently topped, never mind a couple of years ago when most of the news was good. Okay. Plus, we're continuing to get some real oversold readings. For what it's worth, I saw today that over the last 25 trading days, we look at the 25-day average, but 25 trading days on the New York Exchange, the average number of new highs was like 23, meaning the stock's hitting new highs every day. The average number of new lows was 277. So it's like, of the total 300 stocks that have been hitting highs or lows, 92% or something have been hitting lows, it's just a very extreme thing. It doesn't, when I first started in this business, it was like, oh, oversold, but it can stay that way for a while, usually not months or anything, but it can stay that way for 1, 2, 3, 4 weeks, depending what goes on in the world, right? So I still think you want to be alert. You want to see what happens. Some of the resilient stocks obviously have gotten hit this week. That's been sort of the other shoe to drop. So let's see how it goes. Some sacred cows have been hit. Let's see how it goes. But right now it's just about being patient, being defensive, and just letting this play out. When this does, I'm not someone to trumpet sunshine, but when this does end, given all the selling recently, given all the selling of the last couple of years, I saw that the NASDAQ is no higher now than it was in December 2020. A lot of people hear that and they say, the hell with it. I hear that and I say, geez, when we look back 3 years from now, we're going to be counting the 100 and 200% winners, during that time. So the spring is getting very coiled here, in my opinion, when things actually go right in the world, whenever that is, next week, 2 months, I have no idea when. I think there could really be that sustained bull move that we're all really been waiting patiently for the last couple of years. But for right now, it's about being defensive and remaining patient, okay? All right, let's hop into the charts as usual. I'm using a program called MarketSmith. You can learn more at marketsmith.com. It's a product of Investors Business Daily. Get out my pen. So there's not really that much here. Here's the NASDAQ, clearly below the moving averages. It's also below the 200-day line, which in terms of the way we would take action, I wouldn't really take too much action on that. Let's see what happens. Maybe this is the beginning of a huge meltdown, but a lot of times these things will dip, like here, dip below the 200-day line here and then snap right back. So I wouldn't call that a precise indicator. More important to me is the intermediate term trend, which is clearly lower, below these moving averages, obviously heading lower on the NASDAQ. And that's been sort of the weakest index. So like before this, that was holding up better. This week, everything's down, but like the broad market's not good, but the NASDAQ and some of these resilient stocks are worse off. So just running through the indexes just because that's what we always do. S&P 500, not so good, new correction lows. There is some, support theoretically around here, so we'll see what happens. But okay, and then you just start racing through, small caps. The IWM is really, it's either hitting or close to hitting new bear market lows, really, since the top back here. Okay, so this is on the weekly chart. Hard to see on this, so maybe it is tagging it. I'm not sure about dividend adjusted, but either way, it's pretty weak. Mid cap, same, not quite as bad, but same sort of thing. Clearly in a downtrend. And the New York Composite. Okay, and I'm not going to sit here and go through horror show, but I just want to show you what's going on. This is the unweighted S&P, so this is equal weight. So Apple has the same weight as whatever the 500th stock, biggest stock in the S&P. Okay. And this thing is back down. Again, these charts are not dividend adjusted, but this is back down to basically where it was during the March banking crisis, down for the year, that sort of thing. Dow Transports, total horror show. Medical devices, I think I mentioned this. These things got killed on the weight loss drug, but I think really it's just a sign of a weak market. Industrials. And one thing that's starting to pop up more and more, which we always keep a loose eye on if you're a student of the market, is the financials. This is XLF. And just kind of, even today, it's really kind of nosediving. I don't know. It's just, some of these big banks don't look so good and all that. So we'll see how it plays out. I mean, it's not like they're that much weaker than everything else. But, okay. And then, of course, you look at interest rates. This is the 10-year note. Has hit some resistance here at this. This is 50, means 5%. We'll see. I'm all for it. Like if we start to exhale a little bit, at some point these rates are not going to, they're not going to go up, like I said a few weeks ago. They're not going to go up 25 basis points every week or two. They're going to start to settle down. Inflation will settle down, all this sort of thing. So that will be a positive for the market, but it hasn't happened yet. Same sort of thing with, this is the 5-year note. We got up here near 5%, is backed off. So a good couple of days, I guess, but what you'd like to see is just some sort of almost break in rates, something, whatever causes that, an economic report, something around the world. Could act, even though the news might be bad in the world, it could actually be bullish for the market. But we'll see how it goes, okay? I will just say, me, I'm always looking for kind of relative strength. It doesn't look great. This is the XME, which is materials. So it's mixed. Some oil stuff doesn't look good. Nothing looks great. But some oil stuff doesn't look good. Some of it does. Some energy stuff is trying to turn around. So this is sort of the XME. Again, it's not great. But when I look at this sort of action, it doesn't look like some sort of huge meltdown in the past few days. IGV, this is a little bit weighted with some big cap names. But this is software, actually, which is, true blue growth. And this looks a lot kind of like the NASDAQ did last week, right? Where it's kind of hanging around these lows from from August, I should say, which is pretty good compared to everything else. Okay, you can see it's really not that far from a new relative performance peak. And believe it or not, even, I'm not going to go too far with this because there has been some damage with everything else the last week or two. But this is the chip index, which I have to say, it's not a disaster. It's at the 200-day line. It's still stronger than most indexes, still stronger than the NASDAQ. It's not strong. You still need to see it go up. Going down less than everything else still loses you money. But I'm just kind of flagging it, keeping an eye on it. It has been sort of I think it's been kind of the leading sector anyway this year. So let's just kind of see how it goes. The only other thing I would say, again, I'm not going to trumpet sunshine. Since the July peak here, we're down, say, 10% in the big cap indexes and 15 to 20 in the broad market. Just round numbers, okay? This is the third leg down, and it doesn't mean there can't be a fourth and a fifth, of course, but you do often see the 3 legs down pattern in these corrections. So I'm not predicting anything. We're defensive. We're holding a lot of cash, obviously, and have been for a while, and actually did a little bit more selling this week. We're about 3/4 cash now, but let's see how it goes. The news is very bad. It's pretty obvious. We're kind of below the 200-day lines. Let's see what happens over the weekend and go from there, okay? It's a hodgepodge of list of stocks, of course, but I always want to keep my list going. You never know. I remember in 1999, this is not 1999, of course, but I remember the market, there was like a productivity report, which barely anyone paid attention to, and it was much better than expected. And the NASDAQ gapped up, and of course that was the start of the final bubble run where the NASDAQ doubled. So you never know what can kind of cause the turn or whatever. So you just want to keep your eyes open. Like I said, there have been some pretty good looking energy stocks. This is Range Resources, RRC. It's still kind of in this longer base going back to 2022, like a lot of things. But more recently, it did kind of pick up steam, and you can just see every time it's kind of pulled back, it's bounced back, pulled back, bounced back, pulled back, bounced back here. And then just for me to clean up the chart, right here in the last, I guess this was Thursday, it found some support near the prior highs, kind of a shake and bake on earnings, okay? This is it's more on the natural gas liquid side. This is also natural gas, Antero Resources, AR. Again, it's a turnaround play, big decline, bottomed out on the weekly. And this is kind of its first launching pad, base building effort, whatever you want to call it. But again, you kind of had this shake and bake action yesterday after earnings. Okay, so we'll see how it goes. They're down today. Maybe it keeps going, but risk reward wise, if you're heavy in cash and you're maybe looking for decent, like a nibble, but it's a decent risk reward. Some of these things that do react well to earnings, if you get a right spot, you can kind of put a stop. I'm not giving specific advice here, just to be clear, but you could put a stop somewhere, relatively near the prior low, thinking like, okay, if this doesn't work, I don't want to own the stock anyway. Anyway, you're just kind of trying to find some of these situations. But I do think the natural gas things, which have been out of favor for a while, could be turning around. And they're a little bit less dependent on the world. It's really more about kind of what's going on here in production and stuff like that. Okay, moving on. Sort of also on the energy front, energy shippers have been strong. The group is as cyclical as they come. This is Frontline, is probably the best looking one out there. And it actually did break out from sort of a structure 3 weeks ago. It's been in top 10. Thankfully, we have, a couple of winners there, but it's been acting pretty well here. Extended, but, something to watch. I still think cybersecurity, we'll see what happens. It's pulled back. This is CrowdStrike. I'm not saying like, hey, this is nothing, but at the same time, it's still above the 50-day line. It's not that far from its high. A couple of good days, it's going to be in good position, if it has a couple of good days. So it's just much stronger than the rest. Even like a Z-scaler, which is worse, a little bit below the 50-day line. But again, it's just, this was the August low. We talk about kind of these higher low type of action while the market's hitting lower lows. It doesn't mean anything until it does, until the market can kind of confirm an uptrend and the stock kicks into gear. But the point is, I still see some cybersecurity stuff that looks somewhat resilient, I guess I would say, not great or whatever, okay? Adobe, same sort of thing. Oops, ADBE, sorry. Again, kind of straight down action here, so I'm not picking bottoms, but I'm just saying after coming down a bunch of days in a row, it's still higher than its August low. It's still higher than its September low, okay, to this point. Okay, so let's see how that goes. Some of these things, all of a sudden the market gaps up on Monday or turns around. There could be it's showing some relative strength there, so some work to be done. ServiceNow, again, it's kind of messy in here. Big picture, I think the biggest thing with this one is, it's not the young buck it was 6 years ago or whatever. So it's a little bit more mature, but it's still growing great. This is amazing. They just reported earnings, all the sales and earnings growth. These estimates are low, I'm almost positive. So different GAAP and non-GAAP. But, right here, just a very controlled consolidation in here. It's 9% off its high. I know it's a little bit less volatile. It reacted well to earnings, got dragged down by yesterday's market, collapse, at least partial collapse. But it's hanging in there. So just something I'm watching. It's not going to be your, fresh new leader, but I also think the stock could do well. It looks like it wants to go higher if the pressures come off the market, okay? Eli Lilly, this is another one, again, I'm featuring a lot of, me, I like stocks that are going sort of up and to the right, on the chart. I'm looking at a lot of stocks that in the last couple of weeks are doing this, and it's kind of like, wait, Mike, why do you like that? I'm not saying I'd be buying it here. I'm just flagging it because, again, like here's your August low, here's a low here. It's below the 50-day line, and if we come in next week and it just goes down every day, obviously I'm not going to be jumping in. But to this point, I still think it has, you can look at the RP line. It's right near its peak. So a couple of good days in the market from the stock, some good news. It's got earnings next week. If the thing gaps up, all of a sudden it's like, whoa, hey, this thing's still in good position, okay? NVO is a little bit worse, but still swimming together. Full disclosure, we got stopped out. We had to stop just below the 50-day line on this one. So it kind of went, we had it up here, went down, up, back down again. But I think they both, big picture, if you don't own any, are still worth watching, okay? DELL, this is more of a kind of a cheap AI play. It's not like, when you look at the numbers, it's not, like, oh, wow, it's growing super fast. But they've been crushing estimates. They don't have earnings for another month. And again, it's just holding in this range. To continue to hold in this range this long, it's pretty impressive to me, even though it's not, a super clear growth stock, so to speak. So DELL is one. I wanted to mention NVDA here. It's the 400 level is getting a lot of attention, okay? So I don't have any like great grand plan here, but to me, I just, again, not to keep saying the same thing, but when you look at, say, this is the spiders, right? Here's your August low. Here's your, call it September, October low, early October. And then here's your, so far, late October low, okay? So clearly, lower lows in the market, okay? And this is the big cap. Small caps are worse than that. So when you look at sort of the mega cap stock like NVIDIA, and it's basically ballpark the same lows, right? August, September, and October so far. It's worth watching to me. It's one of those things, again, it wouldn't take more than a couple of good days to have this looking like, wow, this could be breaking out soon, if the market was turning around and stuff. Not saying be plowing into it here, but just something to flag, okay? Chinese stocks, interestingly, PDD, it's not, yes, there's some selling on strength here, obviously, but, the fact that it's still holding the 25-day line at this point is pretty good. Now, there's been a lot of these stocks that have, quote, meat left on the bone have been hit. But to me, again, the longer these things hold up, the greater the chance they want to continue higher. Okay, so PDD's one, EDU reported earnings. This is New Oriental. You can just see it's all over the place because of the market and earnings and stuff like that. But the numbers are, just to show you the weekly chart, but the numbers here are really turning around. The government screwed things up a couple of years ago. Now it's sort of moved into other areas. But a nice breakout here, and it's just been kind of grinding higher, and now it's, I wouldn't say letting loose on the upside, but it's trying to let loose on the upside. Clearly a lot of buying pressures here. So Chinese stocks, there's definitely a lot that still are languishing. But there's some of the ones that aren't, like the Alibabas and things like that look pretty good, okay? And just a couple more names that I'm just saying. This has been in top 10 a few times. This is Abercrombie and Fitch. There's a couple of these retailers that it's a little bit more of a special situation, but they had huge supply chain crunches and all that stuff during the pandemic. Obviously the bear market, stocks got killed. They started to come back and the stock changed character. Now, to be honest, to be fair, I should say it's been, say, 6 months since then. So it's not in the first inning here. But again, when the market's doing what it's doing and a stock can kind of hold up, I tend to give it the benefit of the doubt, right? And the stock is actually might close. We'll see how it closes this week. Kind of 3 weeks tight, which is pretty, in this environment is pretty, I don't think there's going to be many there. I haven't run those screens in a while. But anyway, Abercrombie is one of these retailers that looks pretty good. Earnings are booming back this year. Next year, they're supposed to be flat. But A, the valuation isn't bad, and B, they've been crushing estimates, so I think most people think it's low. And then last but not least, this is just an old friend, but I just noticed this is Wingstop. It's not really in position here. Chipotle is kind of I'll just mention Chipotle, which is a $2,000 stock. It is reacting well to earnings today. Nothing really doing here. I mean, it's off the 200-day line, so I'm all for it working. But we'll see how it goes. I just noticed Wingstop because it actually did bottom here back in around Labor Day. Had a pretty good sized decline. And now it's kind of working its way back. And big picture, I mean, this is different. This was obviously the bear market. But the stock has a history going back of sort of, taking these breaks, correcting 20, 25%. It's not a lightning fast grower. It's just one of these long-term cookie cutter stories. So you look at kind of the weekly chart. There's some tightness near the lows. It's obviously off its lows. The RP line is perking up, obviously, because the market's weak. And it does have earnings next week. So just kind of flagging it. I mean, maybe it gets hit on earnings, but there are some of these names that sort of topped before the market. Didn't top here in July with the market. It topped 2 or 3 months ahead of time. Might be a little bit more advanced in terms of having already gotten out some of the weak hands. Okay, we'll see how it goes on earnings. Just back to the market. Again, there's really not too much new to say here, but just keep your head up, keep your eyes open. And if you're out of gear with the market, try to get in gear. I'm not saying go sell 10 stocks today. I'm just saying, work to get in gear with the evidence of the market and the evidence of the stocks you own and stuff like that. But overall, I think clearly we're in a downtrend, but there's a lot of, there's a lot of indicators that are pretty close to where they were, maybe not in '08, but in, 2019 and 2016, which was like a mini bear market and stuff like that. Just major lows when the market did get hit pretty hard. So let's just keep our eyes open. If the market can just kind of get off its knees, stabilize a little bit, maybe interest rates exhale, I think that, we could at least bounce here. And if things actually go right in the world, which I know, whoa, is such a crazy concept, but if things actually go right in the world, I still think that there's a chance that the market can surprise on the upside going forward. But right now, you have to wait. You have to wait to see it before you act on it. So right now, you want to be, keeping your eyes open, keeping your watch list up to date. But right now, you also want to be staying safe as well. Okay, that's all the time I have for today. Thanks for listening. And as always, come by again next week for another Cabot Weekly Review.